Good bounce for stocks today, and it looks like we are finding some footing. The next 2 days will be mostly economic and macro focused. We got a few cloud earnings this afternoon, and they're mixed. The attention is going to shift to jobless claims, and then employment, and then Powell and the rest of the Fed speakers that are on deck for Friday. And that's why today's focus on bonds is important. I've had the green light on bonds since mid-February before I went on the first of 2 vacations, so I kind of missed a week almost. But the green light for bonds was very important because it was an early sign that risk off was building, as was the weakness in crypto. The red light I still hold there because Bitcoin hasn't closed its election gap where many of the other important risk assets like stocks have. That's why I've had the yellow light on stocks, because until they go through that election level, I feel that we are still kind of largely range bound. And even though the dollar's been getting absolutely pummeled here, I'll look at the chart there today because I think the yellow light still describes a big range for the dollar, but a really important one, and the potential for lots of whips on the dollar. But the green line on bonds goes yellow for now. I actually meant to do this yesterday and I forgot, sorry, because the chart was looking like this was a place for resistance in price, support for yield. Look at the 10-year. Now, again, this is totally going to depend on how the data go. But the fact that we were rallying coming into this week in bonds, and actually in the start of the week too, and then we turned around midday yesterday and we continued the bond selling into today is really important. You really needed to hold this line. I said multiple times, you don't want to break this line and yield to the downside, because the whole post-COVID regime of yields being supported has been a good message about the economy. Even though it creates some fluctuations, some difficulties for stocks, sometimes if yields go up, you generally want to root for yields to stay higher. You don't want them falling apart like they were in this pseudo kind of growth scare that we've been through the last couple of weeks. So yields holding at 4.2, that's important. No idea where they go from here. That depends on the economic data. If we miss big on the numbers, then when we're in this state of paranoia that the market's been in, then all right, that green light will go back on and yields then could really explore room to the downside. But I just don't think you want to root for that situation. So that's why I think the stock market had a really good day today, because bonds took the message from the ISM services and stayed in a positive tone there. That's good. The fact that bonds were able to sell off on our services print was really encouraging. Now, the dollar chart's gotten walloped, obviously, but here's the thing. The dollar actually still has a decent amount of space, not tons. Like, we erased most of it. You've pretty much unwound the tariff premium that was getting built into the dollar. That's the election week down there. This chart is normalized to the first week in November. So you've got like some room here where the dollar could still close the gap even further, but it basically has. To me, that says that there's still a lot of volatility potential here, because we've taken the tariff premium, we've closed it out, but you still have the potential, if our economic data come in strong, that maybe Europe's not going to totally steal our thunder on the economic stage. And you also just have tariffs then that have kind of reset. So if there's anything that's extremely hawkish on the tariff front, or some surprise, or some new one, then the dollar's probably ready to bounce again. But the main conviction is that bonds are in a better place, sending a positive message for stocks. I think that's why we rallied today. Hopefully we get a good number tomorrow to keep it going.